You know, have you ever considered that the biggest danger in investing actually isn't always being wrong? Just think about that for a second. Because sometimes the absolute biggest danger is actually being right, like making a massive, life-changing gain and then just sitting there, totally paralyzed, while you watch the whole thing evaporate. Today, we're talking about high-stakes investing and really how to survive the very real, very terrifying dangers of incredible success.
Welcome to This Explainer. I'm so thrilled you're here with us because today we're taking a truly cinematic journey into one of the most powerful yet wildly misunderstood financial tools out there. We're demystifying LEAPS. And look, this isn't just your standard buy and sell stuff. It's honestly an epic story of patience, riding massive long-term trends, and the ultimate battle to protect your wealth. So let's just dive right into it. Section 1. The Long-Term Options Secret. So when most people hear the word options, they immediately picture, a frantic day trader making some wild, stressful gamble on what a stock is going to do by next Friday, right? Well, we need to completely shatter that illusion. Enter LEAPS. It's an acronym that stands for Long-Term Equity Anticipation Securities. Simply put, these are long-term options, and they are your primary weapon for a totally different kind of strategy. Because instead of betting on a chaotic coin flip short-term stock move, LEAPS actually allow you to make a calculated long-term bet on a major world-changing trend.
And honestly, here's the absolute key to the whole strategy. LEAPS usually expire way out in the future. We're talking more than a year, often 1 to 2 full years out. That extended time horizon, it's literally everything. It gives the underlying stock the crucial time it actually needs to catch up to your investing thesis. You're not just blindly guessing what happens tomorrow, you're strategically positioning yourself for what happens next year.
So the basic idea is incredibly simple, but man, is it powerful. First, you find a monumental long-term theme. We're talking massive global shifts here. Things like the artificial intelligence boom, the explosion in data centers, power infrastructure, semiconductors, or even huge breakthroughs in advanced medicine. You find the companies that are going to ride this growth over many years, and instead of just buying the stock directly, you buy a long-dated call option.
Now, why do this? Well, because a call option gives you the right to buy the stock at a specific strike price. And if that underlying stock shoots up, your option can rise much, much faster than the stock itself. That's the incredible, almost cinematic power of leverage. But hear me out on this stark warning. Leverage absolutely cuts both ways. If the stock stalls out, or even if it just moves way too slowly, your option loses value. And in the absolute worst-case scenario, it can expire completely worthless. Zero. This is exactly why you only play this game when you really have an edge and a deep, deep understanding of the theme you're betting on.
Section 2. Choosing the right leap.
Okay, so you've got your theme, you've got your conviction, but now you actually have to choose your specific instrument of attack. And believe me, this choice makes all the difference in the world. Deep in the money LEAPS offer this sort of durable protective shield. They have a strike price that's far below the current stock price. Now, yes, they cost more upfront, but they're resilient and act a lot more like actual stock ownership. We call this the ownership style. On the flip side, you've got at-the-money LEAPS, which act kind of like an explosive rocket ship. The strike price is right at the current stock price. They're cheaper, and they have this massive upside torque, but they're incredibly fragile because they need a much faster move just to offset the time decay. That's the timing style. For a long-term, patient strategy, that deep-in-the-money option, that protective shield, often makes the most sense because it actually gives you the staying power you need to survive the journey.
Section 3. The Power of Patience.
And staying power is exactly what you need here, because this next phase of the strategy, it's almost entirely psychological. You're trying to identify a major future trend way before the broader market fully prices it in. And you know what that usually means? It means being early. It means watching your options value swing wildly up and down. But most agonizingly, it means sitting through absolutely nothing, just waiting and waiting. This is exactly why your position sizing is just absolutely paramount. If your position is way too big for your account, the stress of that weight will completely break your discipline long before your thesis even has a chance to play out.
But let's say your patience actually pays off. The market finally wakes up to your theme and boom, your option explodes in value. Well, right now, you must make a crucial, fundamental shift in your brain. You have to forcefully pivot out of growth mode, where you were just, riding the thesis and letting the leverage do its thing, and you have to shift entirely into protection mode. Because now, your primary job is actively defending those massive, newly minted, unrealized gains.
Section 4. The round-trip danger.
So why is that shift to protection mode so critical? Well, because there is this terrifying monster lurking in the shadows of literally every great trade, just waiting to destroy an unprepared portfolio. I mean, imagine opening your account and seeing this number staring back at you, a 400% gain, or maybe it's 300, or heck, even 800%. You were right about the trend. It's a massive, life-changing win, and the euphoria of that moment is totally blinding.
But this is exactly the moment when you must pause and ask yourself this single dramatic question. How much of this gain am I actually willing to give back? Because if you don't have a strict plan to protect that gain, you are entirely at the mercy of the market. Think of your trade like a massive mountain peak. Your leap has climbed all the way to the top. You've got those big, beautiful gains. But looming right below you is the treacherous pullback zone. This is the very real danger of round tripping. The market pulls back, and your massive 400% gain plummets straight down the other side of the mountain, right back to break even, or even worse. To survive that descent, you absolutely need strict risk management tools. You have to protect your capital, manage the drawdown, and ultimately stay in the game.
Section 5. Protecting your big winners.
To conquer that mountain without falling right off the cliff, we have to deploy disciplined, totally logical defense tactics. Really, you have 4 clear, methodical actions at your disposal. First, you can trim. This simply means taking a few chips off the table by selling some of your contracts, while keeping the rest to capture any future upside. Second, you can roll. This is where you sell your current option and buy a new one with a later expiration date, or maybe a different strike price, to essentially lock in your profits while still staying in the trend. Third, you can hedge. Maybe you sell some shorter-term calls against your long leap to generate a little income and protect against a sudden drop. Even though, yeah, this might cap your upside a bit. And fourth, you can hold. You just give your leap room to grow if you really believe the thesis is still in its very early stages. The entire key here is to make these decisions logically before the emotions take over.
To help make those decisions, you need to run through a protection mode checklist. Really ask yourself, is this position now way too large for my overall account? Is there a major catalyst coming up soon, like an earnings report, that could cause a massive, unpredictable swing? And finally, what about taxes? In the US, holding an investment for over a year can actually qualify you for much more favorable long-term capital gains rates. And that's a huge benefit of using LEAPS. But please, hear me clearly on this. Waiting around solely for a tax break is incredibly dangerous if the risk of a round-trip drawdown is high. You always have to weigh that tax benefit against the catastrophic risk of just losing the gain entirely.
Section 6. The LEAPS Master Plan. All right, so we've covered the themes, the tactics, the patience, and the protection. Now let's bring the whole thing together. I want you to picture a highway just stretching out into the sunset, passing through the years 2025, 2026, and well beyond. This perfectly captures the vibe of the entire strategy. You are combining a multi-year time horizon with deep theme-based investing to capture this incredible asymmetric upside. It's not about frantically chasing hot stocks, and it's certainly not about getting rich overnight. It is all about a disciplined road ahead. Think long, position smart, profit big.
If there is one ultimate lesson I really want you to burn into your memory today, it's this. Buying the right option, actually calling the right trend, that is only half the game. Managing the winner once you finally have it, that's the rest of the game. That is how on-paper gains actually transform into real, lasting wealth.
So, I want to leave you with a bit of a challenge. Take a hard look at your own portfolio, and honestly, your own discipline. When you inevitably hit that massive mountain peak winner, are you going to let it round trip all the way back down to zero? Or do you finally have a plan to protect it? Thank you so much for joining me on this explainer diving into LEAPS. Keep learning, keep refining your process, and I'll see you next time.